We are starting a new topic, and the topic is transfer pricing. A quick more like a stock taking of what we have done so far. The topic we have treated so far about 6 topics by my count. We have treated cost estimation. We have treated price theory. We have done life cycle costing, target costing. We have treated theory of constraints and throughput accounting. Number 6, we have looked at activity-based costing. We have treated divisional performance evaluation. By my count, topic by topic, we have treated like 7 topics. Tonight, we shall be looking at transfer pricing. Let me say that this topic is very related to, is closely related to divisional performance. Under transfer pricing, we shall be looking at what is transfer pricing, what are the conditions for transfer pricing, what are the objectives or qualities of a good transfer price. Then we shall look at method of transfer pricing, and we shall round up the topic with identifying ID transfer price. So we have like 6 outlines to be discussed. One is, what is transfer price? Let us go to the business proper. Now, transfer price. Before the definition, where a company, let's do a brief explanation. Where a company is operated along divisional structure. Where a company is operated along divisional structure, it is very possible that one division will produce goods or service required by another division within the same organization. I will take that explanation again. Where a company is operated along divisional structure, it is very possible that one division will produce goods or service that is required by another division within the same organization. That means we have interdivisional transaction. One division is selling goods to another division within the same company. This is called interdivisional transactions. These transactions must be priced. There must be a price for the goods manufactured by one division and transferred to another division within the same organization. There must be a price for this transaction. The price for internal transaction, the price for interdivisional transaction is called transfer price. The price for interdivisional transaction is what we call transfer price. Transfer price can be defined as the monetary value attached to goods and services exchanged between divisions of the same organization. Transfer price can be defined as the monetary value attached to goods or services exchanged between divisions of the same organization. It is the price for interdivisional transaction. We have defined transfer price. We have tried to explain transfer price. For example, we have Dangote Sugar and we have Dangote Bakery. Of course, Dangote Sugar specializes in the manufacture of sugar. Dangote Bakery specializes in bakery businesses. Now, if Dangote Sugar is selling sugar to Dangote Bakery because sugar is required to bake a bread, where Dangote Sugar is selling sugar to Dangote Bakery, there must be a price for this transaction. That price is called transfer price. Please note, transfer price is the internal selling price. Transfer price is the internal selling price. Transfer price is also the internal purchase price. Please note, transfer price is the internal selling price. That transfer price is also the internal purchase cost. The following points should be noted. The following points should be noted. 1. Transfers are internal transactions. To the selling company, to the selling division, transfer price we create, internal transfer, we create state revenue, internal sales revenue. To the selling division, internal transfer will create sales revenue to the buying division. Internal purchases will create purchase cost. Please note, once there is internal sales, there must be internal purchase. If Dangote Sugar is selling sugar to Dangote Bakery, to Dangote Sugar, that will generate internal sales revenue. Dangote Sugar is selling. That becomes internal sales revenue. To Dangote Bakery, it becomes internal purchase cost. Dangote Bakery is buying sugar from Dangote Sugar. So please note, you are going to have internal purchase. You are going to have internal sales. That is point number one. Point number two, transfer will affect the profit, excuse me. Transfer will affect the profits of the individual divisions. Transfer will affect the profits of the individual divisions. But internal transfer will not affect the profit of the company as a whole. Please, this point should be noted. Internal transfer will affect the profit of the divisions, but this will not have any impact on the profit of the company. Internal transfer does not affect the profit of the companies as a whole. The only time the company will make profit is where there is external sales. Please note, the only time the company will generate profits, it is when we have external sales. All right. Conditions for transfer price.
Breaking, please.
Condition for transfer pricing: one, the organization must adopt a divisional structure. You can only talk of transfer pricing if that company is operating along divisional structure. Point number two, each division must be autonomous in nature. That is, divisions must be independent. Condition number three, the division must be identified as a profit center or investment center. A division cannot be a cost center. Condition four, one division must manufacture a component or sub-assembly. That is, one division must manufacture a product that is required by another division for you to have transfer price. one division must produce a component or manufacture a component which other division will require for the purpose of its final products. Then lastly, condition number 5, the management of the two divisions must be willing and ready to transact business with each other. That is, Dangote Sugar, for example, should be willing to transact business with Dangote Bakery. Dangote Bakery should be willing to transact business with Dangote Sugar. Next discussion. Quality of a good transfer price. The quality of a good transfer price. 1, a good transfer price must allow for performance evaluation. The transfer price must allow for performance assessment. Number 2, the transfer price should guarantee divisional autonomy or divisional independence. Number 3, the transfer price should be motivational. That is, transfer price must not demotivate anybody. The transfer price you are trying to determine should not demotivate divisional manager. It must encourage divisional manager. Then lastly, the transfer price, a good transfer price should promote Go Congress. A good transfer price should promote Go Congress. All right.
Yeah. So what is the meaning of Go Congress or Go Congress?
Okay. Go Congress means divisions must work in the best interest of the corporate head office. Go Congress means the objective of the division must be the same with the objective of the corporate head office. Now look at Dangote Sugar, Dangote Salt, Dangote Cement, Dangote Bakery. These are divisions of Dangote groups of companies. Dangote groups of company has a mission statement. Dangote groups of company has its primary objective. If the objective of Dangote groups of company is to make profits, then the objective of all the divisions should be to make profits. If the objective of Dangote groups is about maximizing profits, then the objectives of all the divisions within Dangote groups must be to maximize profits. That is go congruence. The objective of the division must be the same, must be in line with the objective of the corporate head office. A division must not work at variance with the corporate head office. So at every point in time, divisions must work in the best interest of the corporate company, because you are a division. You are not the owner of that division. Somebody established that division. That division was established as part of a division of a particular company. So your objective must be in line. Is that clear, man? All right. All right. Our next discussion, method of transfer pricing. The method of transfer pricing. One, cost-based transfer price. One, we have the cost-based transfer price. Under this method, the relevant transfer price between the buying division and the selling division is based on the actual cost of production. Cost-based transfer price. The transfer price between the selling division and the buying division is based on the actual cost of production of the product being transferred. That is cost-based. For example, if Dangote Sugar has produced a bag of sugar for 5,000 naira, then sugar will be transferred, one bag of sugar transferred to Dangote Bakery will be transferred at the cost of production. What are the advantages of this? One is it eliminates complexity associated with stock valuation. If you transfer based on cost, that means you are not adding profit to it. So there's no, it removes complexity with stock valuation. This approach is not prone to market fluctuation. Cost-based method will motivate the buying division. The buying division will be happy to buy. Cost-based method is good for planning purposes. But this method has a lot of limitations. One is it does not allow for initiative. Divisional managers are not allowed to use their initiative to determine the price of a product. This approach may encourage suboptimality. That is, a division may not be working in the best interest of the company. This approach is not suitable for performance evaluation, especially where the division is identified as a profit center or investment center. The cost-based method will negate the concept of divisional independency. The cost-based method will negate divisional autonomy, no freedom. Number 2 method. Please be attentive to this. Please be attentive to this. Question is always around this number 2. Market-based transfer price. Under the market-based transfer price, the relevant transfer price between the selling division and the buying division is based on the prevailing market price of the products. Under the market-based transfer price, the relevant transfer price between the selling division and the buying division will be based on the prevailing market price of the products. As at the date of that transaction, for you to talk of market-based transfer price, it implies that the items being transferred has external market. For you to be talking of market-based transfer price, it means that that item that is being transferred internally has an external market, and there's external market price. The item being transferred has an external market, and there's external market price. In this case, that external market price will be used as the transfer price for internal transaction between the buying division and the selling division. This transfer price, you can either take the market transfer price or market transfer price less cost savings. Cost savings in packaging, distribution, and selling cost. Where there's cost saving in packaging, distribution, and selling cost. Let us explain that briefly. When we say market-based transfer price, we are going to use that illustration of Dangote Sugar and Dangote Bakery. Now, let us assume that Dangote Sugar, a bag of sugar, a bag of 25 kg sugar for Dangote is sold for 10,000 naira at the market. A bag of Dangote sugar is sold for 25,000 naira at the market. Now, if Dangote sugar is selling sugar to Dangote Bakery. If Dangote Sugar is selling sugar to Dangote Bakery, remember both divisions belong to the same company. Dangote Sugar will sell at the rate of 10,000 naira to Dangote Bakery. That is the market price of the product. Or it can sell at market price, less cost savings on packaging, distribution, and selling costs. Let us explain that. Normally, if you want to sell the sugar, that sugar will be packed in bag. They will also be packed in cartons, maybe 25 kg, and you have like 4 in a carton. You now sell to the external markets. If Dangote Sugar is selling sugar to Dangote Bakery, it is not a must to package the sugar. That packaging may not be needed because you are selling to your internal what? To your own division. You are selling to a division within your company. You don't need to start packaging that sugar again. You can just measure the sugar in drum and just take it to Dangote Bakery. That means packaging cost has been saved. That packaging cost saved, you can now say market price minus cost savings on packaging. That means Dangote Sugar is not incurring packaging costs on the amount of sugar transferred to Dangote Bakery. So we are saving that cost. Selling cost. Dangote Sugar will not need to transport the sugar to the market. It will just transfer the goods to a bakery. That means there could be cost savings on selling and distribution. Where the examiner specifies cost savings, then the market price less cost savings. That becomes our transfer price. We are still not done on market-based. Like I said, for you to talk of market-based transfer price, there must be an external market for your products. People are willing to buy that product outside. Now that external market is referred to as the intermediate market. The external market is also known as the intermediate market. These external markets could be perfect external markets or imperfect external markets. These external markets could be perfect external markets or imperfect external markets or non-existent external markets. We have to explain these three because these three concepts we have impact on calculation. The first one, a perfect, just 1 minute, please. All right, thank you. You can't do this talking without taking water. Now, perfect. What are you saying, sir?
Are you saying you call for water?
Let's continue, Joe. A perfect external market. This is a situation where it is possible for the division to sell all its outputs, where it is possible for the division to sell all its output fully at the external market. A perfect external market is a situation where it is possible for a division to sell all its output fully at the external market at the prevailing market price. In that case, we have a perfect external market. Note, where there is a perfect external market, note, where there is a perfect external market, the ideal transfer price is the prevailing market price. Please note, where there is a perfect external market, the ideal transfer price is the prevailing market price of the product. For example, Division A, maximum capacity is 500,000 units. Division A can produce 500,000 units of a product. And it is possible for Division A to sell all the 500,000 fully at the external market. External customers are willing to buy. Division A can sell the whole 500,000 units to external customer at external market price of say 1,000 naira. That is a perfect external market. If Division A is transferring any items internally to Division B, those items must be priced at 1,000 naira, the prevailing market price. That is perfect external market. Number two, imperfect external market. It's a situation where a division has external market for its products, but cannot sell all its output fully at the external market. It's a situation where a division has external market for its products, but cannot sell all its output fully at the external market at the prevailing market price. In such a situation,
that's for imperfect.
they are imperfect.
Hello,
imperfect. Imperfect. In such a situation, that balance remaining, that balance that cannot be sold at the external market is referred to as spare capacity. That balance that cannot be sold at the external market to external customer is referred to as spare capacity. Spare capacity or excess capacity. For example, let's take division A again. Division A maximum capacity is 500,000 units. But division A can only sell 400,000 units at the external markets to external customer. The balance is 100,000. That balance is that 100,000 units is what we refer to as spare capacity or excess capacity. The ID transfer price for spare capacity, please note, the ID transfer price for spare capacity is the variable cost of manufacture. The ID transfer price for spare capacity is the variable cost of manufacture. Although this may demotivate selling division, but the ID transfer price is the variable cost of manufacture. Mr. Techno, sorry, I didn't look at my crowd. I've been speaking. Yes, any question, please?
Okay, sir. Thank you. Can you hear me, sir?
Yes, we can hear you clearly.
Okay, sir. What is that condition? Or is it the company's policy that will make the selling division not be able to sell all its products at the external market? Is it the company policy or is there any condition that will cause it not to?
All right. It's not the company policy. It's because you produce 500,000. When you get to market, you can only sell 400,000. Nobody's willing to buy again. What do you do now? You can't force them to buy.
Yes, yes.
That's the
Do you understand?
market.
Thank you. That is imperfect external market. Thank you, sir. You have produced 500,000. Now you took your product to the market and you can only sell 400,000. You make effort to say nobody is willing to buy. You now return back the unsold item back to the company. When you get back to your office, your division now somebody within your company now say, I want to buy this from you. You are in division A. You have 100,000 spare capacity. When you get back to your office, division B is saying that we want to buy your products. That means division B is helping you because nobody is even willing to buy that product outside. If you are not able to sell this to division B, that means you are going to incur loss because you have manufactured the product. You have incurred cost of manufacturing. So division B is buying from you. He's doing you a favor. So the ID transfer price division B should pay you is the cost of manufacture. Your variable cost of manufacture. Like I said, please note, this may demotivate selling divisional manager. But that is the ID transfer price. Then lastly, we have non-existent external market. It simply means that there's no external market for that product. Customers, external customers are not buying that product. It means that once that product is produced, that product will be transferred to another division. That product becomes the input of another division. A good example, if you look at Mercedes-Benz door, Mercedes-Benz door is peculiar to Mercedes car. That door is manufactured by a division within that company. Once the door is manufactured, okay, it should be my network then. Let me take that again. I said non-existent external markets. It means there is no external market for the items being transferred. If there is no external market, that means there is no external market price. In this case, the item will be transferred at cost. All right.
Hello, sir.
We are done with that explanation.
Hello, sir.
Yes, sir.
Can you please repeat the last statement you made, sir? In this case,
okay, I said non-existent markets. There is no external market for the items being transferred internally. In this case, the items will be transferred at cost because there is no external market price for that item. Is that fine, sir?
Yes, sir. Thank you, sir.
All
sir,
right.
Please confirm full cost or marginal cost.
The concept is to look for your marginal cost, your relevant cost of production. You understand? Whether you produce or not, you are going to incur the fixed cost. Are you there, please? That fixed cost will be incurred.
Okay.
We don't normally bring in fixed cost here, sir. Advantages of market base. This will enhance performance evaluation. Of course, it's going to encourage initiative. Of course, it's going to guarantee divisional independence and autonomy. It can be used to maximize profits. Definitely, it's going to motivate both the selling division and the buying division because we are buying at the prevailing market price. Disadvantages of this method: one, it is prone to market fluctuation. It may create unhealthy rivalry among divisional managers. This method is not suitable for stock valuation purposes. Because there's element of unrealized profits. And lastly, the method is not consistent with historical accounting reporting system. If you look at financial accounting is based on historical reporting. You don't prepare financial account based on market value. It is based on historical value. So this method is not consistent with historical accounting reporting system. Number 3, negotiated transfer price. Under this method, the agreed transfer price between the selling division and the buying division is based on the negotiation between the two divisional managers. Negotiated transfer price is a transfer price based on negotiation between the buying division and the selling division. Of course, advantages, we have 1, the agreed price is a joint agreement, so it's motivational. It guarantees divisional autonomy. It encourages initiative. The approach is not subject to market fluctuation because it's a discussion between the two managers, the selling divisional manager and the buying divisional manager. They will agree. Disadvantages of this method, it is time consuming. Number 2, a domineering divisional manager may sacrifice long-term corporate objectives for personal divisional gains. You know, when you are discussing, some people are domineering. It is their view. It is what they want. And now we have faith. Lastly, the approach may encourage suboptimality because it can conceive inefficiency. Two managers now agree between themselves. Let's determine this price like this. It could lead to suboptimality. Next, arbitrary transfer price. Is the transfer price determined by the central management, that is the central head office, with or without the consent of the divisional manager? Arbitrary transfer price. That means the corporate head office determine the transfer price with or without the consent of the divisional managers involved. The head office will only give order, transfer at this price. That's all. This approach can guarantee the concept of go Congress. It is not prone to market fluctuation. This approach is considered ideal for planning purposes. It eliminates time consumed under negotiated transfer price. Disadvantages. Of course, the method prevents or discourages initiative. The method negates divisional independency. The method is not motivational. The approach will not motivate the selling division. Like you are coercing division to do something. There's no motivation. And it could create unhealthy rivalry among divisional managers. Lastly, we have transfer price based on opportunity cost. Transfer price based on opportunity cost. Where transfer price is determined based on opportunity cost. Where transfer price is determined based on opportunity cost. You are going to require two variables. Transfer price based on opportunity cost, you require two variables. One is the variable cost of manufacture plus opportunity cost of transferring the item internally. The opportunity cost by transferring the items internally instead of selling to the external markets. So the opportunity cost is the alternative foregone. If you are transferring items internally, then the opportunity cost is the loss of revenue or the loss of contribution you will have gotten from external sales. By not selling externally, that means you are losing contribution. Opportunity cost is the alternative foregone. That alternative foregone is contribution lost by selling internally instead of selling externally. Please note, if you are asked to determine transfer price based on opportunity cost, please note, if you are required to determine transfer price based on opportunity cost, you are still going to get back the market price of the product. It will take you back to market-based transfer price. It will take you back to market-based transfer price. Identifying the optimal transfer price. When we say optimal or optimum transfer price, that is the ideal transfer price, the best transfer price. How do we identify the optimum transfer price? The following rules should help us to identify ideal transfer price. One, begin by identifying the arrangements for transferring goods internally that would maximize the profit of the company as a whole? Begin by identifying arrangement for transferring goods internally that will maximize the profit of the company as a whole. In other words, what is in the best interest of the company? Which transfer price is in the best interest of the company? Number two, having identified the transfer price. So having identified the plan that is in the best interest of the company as a whole. Having identified the plan that is in the best interest of the company as a whole. Then determine the transfer price or a range of transfer prices that will motivate the buying division to be willing and eager to work towards the plan. You must be willing, transfer price that will motivate the buying division to be willing to work towards the organizational plan. Then rule number 3. In the same way, having identified the arrangements that is in the best interest of the company as a whole, identify the transfer price or range of transfer prices that will motivate the selling division to be willing and ready to do what is in the best interest of the company. What price will motivate the selling division? To be willing to work towards what is in the best interest of the company. So you must note this. The last aspect of the note, we can also explain it. International transfer pricing. International transfer price. This is a situation where you have divisions located in different countries. It's a situation where you have divisions located in different countries. That will give rise to international transfer price. Like we have Dangote Cement in Nigeria. We also have Dangote Cement in Ghana. So 2 countries are involved. So you should, when you are dealing with international transfer price, please be mindful of the following items. Be mindful of the following items. One is different taxation. One is different tax rates. the tax rates in one country may be different from the tax rate in another country. Number 2 is differences in currency. If Dangote Sugar in Nigeria is selling sugar to Dangote Bakery in Ghana, we have different currency. And government must pay attention to international transfer price. Although within the scope of your syllabus, examiner will not text you on, will not be texted on foreign currency now. You'll not be texted on foreign currency. I think we are fine with this. Any question, please? I think we are fine with the explanation. Other things are just noise. We are done with the explanation. Any question, please?
Sir, based on the explanations you just gave to us, which method will you say is the best to use for transfer pricing? Or is it that the examiner will tell us which one to use?
The best method is any method that will maximize the profit of the company as a whole. And that is the ideal transfer price. You can't say cost is the best. You can't say market-based. You can't say negotiated or arbitrary. But the transfer price must be able to maximize the profit of the company as a whole. And that will fall under optimum transfer price. That optimum transfer price is going to base on scenario. Now ask yourself, which transfer price is in the best interest of this company? Once you establish that, that's okay. Then you must be what arrangements. Now, what will make the buying division to be willing to work towards this arrangement? So it is the optimum transfer price that will give you the best results. And you can only determine that based on scenario method. Until we see question, we now follow the rules. Any more question, please? Sorry, I shared the material list. Actually, shared to the wrong guy. I shared since this thing says.
Yeah, we got the material.
I shared to last diet group. So I was like, oh, I didn't even check it. Now, we go to question. Let us look at question 2. Illustration 2. Joy, please, can you help us to read?
Yes, sir. You can read. Just give me a minute.
Abuja Industries.
Illustration
We are
2.
waiting.
Okay. I'm so sorry. A minute, please. Illustration 2. Sorry. This is illustration. Okay. Abuja Industries has several independent divisions. The company's tube division manufactures the picture tube used in television sets. The tube division absorption costing income statement for last year, in which 8,000 tubes were sold, is given below. We have our total and we have our cost per unit. Sales,
Right.
sales 27,200 and 3,400 naira per unit. Cost of goods sold 16.1 and 2,100 naira per unit. Profits 10.4 million and 1,300 naira per unit. Selling and administrative expenses 7.8 million and 975 naira per unit. Divisional net operating profits 2.6 million and 325 naira per unit. As shown above, it cost the tube division 2,100 naira to purchase a single tube. This figure consists of the following costs. We have our direct materials of 760 naira. We have direct labor 540 naira. We have production overheads, and they told us that 75% is fixed. The total is 800 naira.
All
We
right.
have tube.
Just 1 minute. 1 minute. Examiner says production overhead in bracket 75% fixed. It means that 25% is variable. Production overhead. Examiner says in bracket 75% is fixed. Interpretation is 25% of this is variable, because the production overhead will give us 100%. Please continue.
Okay. The tube division has fixed and selling administrative expenses of 7 million naira per year. Abuja Industry.
Okay, please note that also. No, as you read, you need to also be mapping it. Here we are told that selling and admin is 7.8 million. Now, Alexander now say the tube division has fixed selling and admin to be 7 million. That means if I want to interpret it out, if 7 million is fixed and the total is 7.8 million, that means 800,000 is variable.
Sorry, sir.
Is that clear, please?
No, it's not.
You know, as you are reading question, examiner is sending message to you. You need to interpret the message out. Look at this sentence we have just read. The tube division has fixed selling and administrative expenses of 7 million naira per year.
Yes.
And in this note you have here, we are told that selling and admin expenses is 7.8 million. And the body says fixed selling and admin is 7 million. That means if I compare the two, 7.8 million minus 7 million, I'm left with 800,000. That 800,000 is a variable selling and admin expenses. Is it better, please?
Yes, sir.
How,
Yeah.
sir? How?
Why do you say how?
I don't understand. Sorry.
No, I'm not even blaming you. Somebody say how. I was not wondering. The person is asking a question now. How does it become? Look at it, please. Selling and admin expenses is 7.7,800,000. If you look at this column, we are not told if the selling is fixed, if the selling is variable. Examiners say selling and fixed expenses is 7,800,000. That is given to us in the schedule. We now get to a note. The note says the tube division has fixed selling and admin expenses of 7 million naira. If 7 million is fixed and the total for selling and admin is 7.8 million, what is variable?
The 800,000 is variable.
Thank you. Because somebody say how. I was just trying to explain the question so that when we get to calculation, it is much easier. The person saying how, is it better now?
Yes, sir. Yes, sir.
Yeah, please continue.
Okay. Abuja Industries has just formed a new division called the TV division that will assemble a television set requires a voila. Abuja Industry has just formed a new division called the TV division that will assemble a television set requires a high resolution picture tube. The tube division
That requires
a television set
I've
that requires
added some.
okay. That has a high resolution picture tube. The tube division has been asked to manufacture 2,500 of these tubes each year and sell them to the TV division as one step in determining the price that should be charged to the TV division. The tube division has estimated high resolution tubes. So they gave us the information for it. Direct materials, 1,200. Direct labor, 980 naira. Production overhead, 2/3 is fixed, 1,080 naira. And our total cost per tube is 3,260 naira. To manufacture the new tubes, the tube division would have to reduce production of its regular tubes by 3,000 units per year. There will be no more variable selling and administrative expenses on the intercompany business and total fixed overhead costs. I'm sorry that my reading is a bit shabby. I'm having issues with my eyes.
Thank you.
So So there will be no variable selling and administrative expenses on the intercompany businesses, and total fixed overhead costs would not change. Assume direct labor is a variable cost. We are required to 1, determine the lowest acceptable transfer price from the perspective of the tube division for each of the new resolution tubes. And 2, assume that the TV division has found an outside supplier that will provide the new tubes for 40 naira each.
4,000 naira. For 4,000 naira each.
For 4,000 naira each. If the tube division needs this price, what will be the effect on the profit of the organization?
All right, thank
That's-
you. Thank you. Now, if you look at the question, we have tube division that manufacture tubes. Now, the company has formed a new division called television division that will assemble a television set that requires a high resolution picture tubes. We now have two divisions. We have the tube division, we have the television division. The tube division has been asked to manufacture 2,500 of these tubes each year and sell to the television division. Both divisions belong to the same company. The tube division will now manufacture high resolution tubes. Before now, tube division manufacture tubes normally, but not high resolution. The television division requires a high resolution tube, picture tubes. Now the tube division has been asked to manufacture 2,500 of high resolution tubes and sell them to television division. And there must be a price at which tube division will sell to television division. To manufacture high resolution tubes, we have the direct material cost, we have the labor cost, we have overhead. Examiner says 2/3 of the production overhead is fixed. If 2/3 is fixed, what is the variable amount? If 2/3 of overhead is fixed, what is variable? You are going to interpret this quickly to yourself. If 2/3 is free, it means that 1/3 is variable. You know, when you are reading question, you have to interpret. There are certain information that is implied. Look at the first one. If I say this is, okay, let me check here. I want to move this a bit up. This information is for the regular tubes. The company manufactured before. Now, this information is for high resolution tubes. Now look at this last paragraph, it's very important to us. To manufacture the new tubes, the tube division will have to reduce production of its regular tubes by 3,000 units per year. That is opportunity cost. Is that not, please? For me to manufacture a new product, I'm going to reduce the production of my old products. That is opportunity cost. Is that not, please?
Yes, sir.
To achieve the production of new products, I must reduce the production of existing products. If I reduce the production of existing products, that means the company will suffer reduction in contribution from that old products. That is opportunity cost, alternative forgone. To produce new product, we must forgo 3,000 existing products. Opportunity cost is relevant to decision making. Now the requirement says determine the lowest acceptable transfer price from the perspective of the tube division for each of the new high resolution tubes. The lowest price I'm going to charge you must cover my costs. Is that not?
Yes, sir.
Logically, I cannot go below my cost of production. If I cannot make profits, I must not incur loss. The lowest price this tube division will charge will be its minimum relevant cost of manufacture. That is, what is the relevant cost of manufacture a new high resolution tube? If you now manufacture new high resolution tube, when you have gotten the cost, that's okay. If you manufacture this new tube, we are going to sacrifice 3,000 regular tubes. You now ask yourself, what is the opportunity cost of sacrificing 3,000 units of regular tubes? You now add it to the relevant cost. In fact, I have done my explanation. So let us go to the whiteboard. Good to go? Requirement 1. Minimum acceptable transfer price to tube division. First, our first working relevant cost of new high resolution tools. Please go check. What is the direct material cost? Is relevant. For new resolution, what is material cost? How much?
1,002.
1,200. Labor cost is also relevant. All variable costs are relevant. Labor cost, how much?
980.
980. Then you are going to pick your variable production overhead. Please, only variable cost will be relevant here. Variable production overhead. Examiner says 2/3 is fixed. What is the variable element?
360.
Thank you. There are two ways to do it. You can compute 2/3 of 1,080. Look at it, please. Let's go back to that question. Just do 2/3 of 1,080. When you get the 2/3, now remove it from 1,080. You are left with what?
360.
360. Alternatively, you can just do 1/3 of 1,080. Whichever one you decide to take. Look at the variable. 1/3 of 1,080. That will give us 360. This is the variable cost. Please sum up. Fixed cost is, please note, fixed cost is not relevant to decision making, except you have incremental fixed cost. Variable production costs, note that.
$540.
We now introduce the opportunity cost. By producing the new high resolution tube, the company will reduce production of regular tubes. That means that reduction will lead to loss of contribution. By reducing the production of regular tube by 3,000 units, that means we cannot sell 3,000 units of regular tubes. That means the company is losing what? Contribution on regular tubes. That loss of contribution is opportunity cost now. That must be added. We are losing that money because we need to do new high resolution tubes. Least I forget. Please watch out. Most likely, your number one question will be coming from relevant costing principles. You can't go to that exam without a good understanding of relevant costing concepts. You cannot go to that exam without a good understanding of relevant costing concepts. Okay, let's move on. I need to move this also. Okay, I'll leave this place. This is opportunity. That is the opportunity cost. Opportunity cost. is also our contribution loss. We need to calculate this now. I will now ask myself, what is the contribution per unit of regular tools? My working tool now. My working tool. Permit me to pick red for working tool. Contribution per unit of regular tool. Please, what is the selling price for regular tools per unit?
3,400.
Can we all see it? You come here. I will start with the selling price. The selling price is 3,400. 3,400. Now pick the variable cost for regular tools.
750 direct material.
Is 750 or 760?
760.
Direct material 760. Direct labor
540.
Direct labor for regular tools 540. Next. Variable production overhead for regular tools
200.
How do we get that? Examiner says 75% is fixed. That means 25% is variable. Variable production overhead. We can take the work in here. 25% of 800,000. That will give us 200. Is that all variable cost we have there?
Yes, sir.
Okay, that's not correct. We have variable selling.
Okay.
And admin. We have variable selling. Variable selling. You must always watch out for the hidden information in your question. Go back to the question. I was trying to explain this. Selling and admin expensive, 7.8 million. The note here says the tube division has fixed selling and admin expenses of 7 million naira. Now, if the total selling and admin is 7.8 million, and the examiner says fixed selling and admin is 7 million, that means variable selling and admin expenses is 800,000 naira.
Yes, sir.
Is that point clear, please?
Yes, sir.
Now, we are told that I need to get variable selling per unit. At the first paragraph, the examiner says tube division absorption costing income statement for last year, in which 8,000 units were sold. The company sold 8,000 units. Total selling expenses, total variable selling expenses is 800,000. What is variable expenses per unit?
100 naira.
Let's go show the work. Let's show it here. Look at it, please. Let's show the working here. Total selling and admin expense is equal to 7,800,000. The examiner says fixed selling and admin expense is equal to 7 million. Therefore, variable selling and admin expense is equal to 800,000. Quantity sold. This is Naira. 8,000 units. Therefore, variable selling and admin expense per unit is equal to 800,000 divided by 8,000 units. This is equal to 100. I'll show the work here. We can come back to the first page. This is 100. You can sum up now. What is total variable cost? Come on.
1,600.
You can get contribution per unit now. Contribution per unit. 1,800. We have gotten contribution per unit for regular tools. We are going to reduce production by 3,000. What is total contribution loss?
5,400,000.
Is that not? I can come here. Because of space, let me come here. Come here. Working 4. Let me take that working 3. total contribution loss on regular tubes. I'll come here. 3,000 units reduction multiplied by contribution per unit for regular tubes, 1,800. Total contribution loss, 5 million for what?
400,000.
This is total contribution loss on regular tubes. Please, let me say something. This contribution per unit of regular tubes. I will now come and look for contribution loss per unit of new high resolution tubes. Let me explain that briefly. Back to the question. Let me come here. Look at it, please. To manufacture the new tubes, the tube division will have to reduce production of regular tubes by 3,000 units. That one is set. Now look at this, please. The TV division has been asked to manufacture 2,500 of these tubes each year. That means we are going to manufacture 2,500 units of new resolution tubes. Total contribution loss as a result of new resolution tubes is 5,400,000. What is contribution loss per new resolution tubes? Total contribution loss as a result of producing new resolution tubes is 5,400,000. What is the contribution loss per unit of new resolution tubes? We are going to produce 2,500. Therefore, I can come here. Contribution loss per unit is equal to, look at it. I can come here easily. Is equal to total contribution loss divided by the new tubes to be produced. We are going to produce 2,500 new tubes. What is the contribution loss per unit of new tubes? Please work that out. 2,160. Come here now, come and put it here. Contribution loss, this is equal to 2,160. So minimum transfer price. Minimum transfer price. Please sum the two. Variable production cost is equal to 4,700. The minimum transfer price from the perspective of tube division is 4,700 per unit of new high resolution tubes. Please don't pick 1,800. That 1,800 is contribution per unit of old regular tubes. But the contribution lost is going to be based on new high resolution tubes. So when you get your total contribution lost, divide it by number of units of new high resolution tubes. This will give you your 12 marks. We are done with requirement A. Or requirement 1.
Hello, sir.
Yeah.
Please, can you come again? Like, where do we get this 5.4 million?
Okay. Now we have this 1,800 contribution per regular tubes. Is that clear, please? Do you understand this 1,800?
Yes, sir, yes.
Okay, great. Now we now have this aspect. Look at it. To manufacture the new tubes, the tube division will have to reduce production of its regular tubes by 3,000 units. So if you reduce your sales by 3,000 units and contribution per unit is 1,800 naira, what is your total contribution lost? That becomes just one. I want to show you working. Look at it here. 3,000 units multiplied by 1,800. Total contribution loss on regular tubes is 5.4 million. That is how we got the 5.4 million.
Okay. It's clear, sir. Thank you.
You're welcome, please. We are done with Roman figure with question 1. We are done with question 1. So the minimum acceptable transfer price from the perspective of the tube division is 4,700 naira per new high resolution tube. That is the minimum. That is the least. That minimum will only cover the company's costs. And the contribution forgone on regular tubes. Now look at requirement 2. Assume that TV division has found an outside supplier that will provide the new tubes for 4,000 naira. Full stop. If the tube division meets this price, that means if the tube division agrees to meet 4,000 naira, what will be the effect on the profit of the organization? If the tube division agrees to produce and transfer the components at 4,000 naira transfer price. What is the implication of this on the company's profits? Yes, anybody? Let's look at this. Assuming we are able to internalize, we should be able to get the answer immediately. That's it. 2. Minimum transfer price. Minimum transfer price. Please, TR, transfer price, is equal to 4,700. Outside supplier quotation. Supplier's price, 4,000. Therefore, differences, 700. If subdivision agrees to meet the supplier's price, the company's profits, will fall by, look at it, that is 700 naira difference per unit produced. Subdivision will produce 2,500. Per unit produced, the company will suffer 700 naira loss. Multiply by 700 naira. Please work this out. Total is 1,750,000. The company's profit will reduce by 1,750,000 if subdivision agrees to meet the supplier price. Because we have said the minimum price Sub can take is 4,700. If you now agree to meet 4,000 naira, that means you are losing 700 naira per unit. If you produce 2,500, total loss becomes 2,500 multiplied by 700. That means the company's profit will reduce by 1,750,000. May God give us a better understanding.
Amen.
Please watch out for this question.
Amen.
Okay. Any question, please? All right, we still have like 30 minutes or thereabout. Question number 3. I will read question number 3 to make it faster and deal with this in 30 minutes and go out. Question 3. Please listen to the question. It is very important that as you are reading question in the exam, you also follow the question. That is, you are mindful of the question you are reading. I'll go question 3. Garki PSC is a holding company with 4 divisions, including Alba and Beta divisions. Alba division produces a component that is sold externally and can also transfer to other divisions within the group. Look at that sentence. That Alba division produces a component. It can sell externally. It can also sell internally. Beta division uses the component from Alba division as a raw material for its final product. So when Beta division gets components from Alba, that becomes its own raw material for its final product. The division can also obtain the component from external supplier, meaning that Beta division can also obtain components from external suppliers. The components, when obtained from Alba division, please look at that sentence. If the component is obtained from Alba division, undergoes further processing. That means if Beta division obtain component from Alba division, this component will undergo further processing at a cost of 4 naira 50 kobo per unit before it is sold to the external market. The board of directors, in order to implement a new appraisal review, has set up a performance scheme for the divisional managers. A performance target for the next financial year has been set, and the following budgeted information relating to the two divisions has been prepared. We have Alpha division, we have Beta division. Maximum production and sales capacity. The maximum production for Alpha division, 900,000. Sales to external customer is 700,000. That means if Alpha division, produce 900,000 units, it's going to sell 700,000 units to external customer. It still has 200,000 units, is that not?
Yes, sir. Spare capacity.
Thank you. That 200,000 is to be sold internally now. We are giving the selling price for Alba. We are giving the variable cost of Alba. We are giving divisional fixed cost for both companies. We are giving capital employed. We have residual income, and we have divisional cost of capital. Please remember, residual income is your profit minus bracket capital employed multiplied by the cost of capital. Okay. Next. Beta division has asked Alba division to quote a transfer price for units of the component. Requirement A. Calculate the transfer price per unit, which Alba division should quote to Beta division in order that its budgeted residual income target will be achieved. If you look at this question is texting arbitrary transfer price, a transfer price that is determined to hit a specific target. And that target is residual income target. We don't know the transfer price, but the transfer price must give us a residual income of 700,000 for Alba division. What is this transfer price? To approach this, we must know the internal sales. We must know the internal sales revenue. In this case, we are going to do a walk back. It's like working from your profit now, you know. If you prepare your statement, your marginal costing statement, you have your sales value less your variable cost. That will give you your contribution. Your contribution less your fixed cost will give you your profit. Your profit less profit minus bracket capital employed multiplied by cost of capital will give us the residual income. That means we can do a walk back. Please look at it. We can do a walk back. Oh, requirement requirements A. We have Alba division. To solve this question, you are going to do a walk back. Let's look at it. We start.
I can't see your screen, so.
Thank God, though. You can't see my screen, okay? Oh, don't be annoyed, though. I'm surprised. You see it now. Yeah. Now focus on Alba division. What is the residual income for Alba? What is the residual income for Alba division?
700,000.
Take the add back plus, look at it. The capital employed Capital employed multiplied by cost of capital. The cost of capital for ABBA. I want to see. Take it here. Capital employed multiplied by the cost. Go check. What is the capital employed for ABBA?
4 million.
Multiplied by the cost of capital for ABBA. That will give me 4 million multiplied by 12%, Abby.
Yes, sir. 480.
480. Add back. This will give us the profits. Is that not, please? Add back. What do you have?
1,180,000.
1,180,000. To some people now, it's like magic. Look at it. Residual income is equal to profit minus bracket capital employed. Multiplied by cost of capital. We are told that the residual income is 700,000. I don't know the profit yet, but I know that the capital employed is 4 million. I know cost of capital to be 12%. Please, what is profits? Just do a walk back. What is the profit? 1 million. This will give me 700,000 is equal to profit minus 480. My profit is equal to 700,000 plus 480. I've just done this to show you the work. We have gotten the profit. I want to know the sales value of ABBA. Total sales value. Add fees cost. Divisional fees cost. Divisional fees cost. What is the fees cost of ABBA division?
160,000.
Please, fees cost plus profit will give us what?
1,340,000.
What is that term? What is it called? What is it called? Contribution.
Contribution.
You have done marginal costing. This should be coming back to you. That's contribution. Because contribution minus fees cost will give you your profit. That means profit plus fees cost is equal to contribution. Next, our variable costs. Trying to look for this thing again. I'll come here. I just want to move this up a bit. I'll come here. Variable cost. What is the variable cost of Aba division.
4 naira 90 kobo per unit.
Okay, great. How many will Aba division produce?
700. Okay. 900,000.
900,000.
Okay, great. 900,000. 900,000, the variable cost, 900,000 multiplied by 4 naira 90 kobo. What is total variable cost?
4,410,000.
Okay, I'll come here. 4,410,000. Contribution plus variable cost will give you what?
Sales.
We give you your total sales value. You are just doing a work back. Total sales. Please add
5,750,000.
750,000. This is the total sales. For division Aba, total sales is 5,750,000. We now differentiate. We have external sales. We have internal sales. What is the external sales for this company?
700,000.
Thank you. External sales is 700,000 units. What is the external sales value? External sales value?
6 naira 80 kobo.
Thank you. External sales for Aba, external sales value for Aba is equal to 700,000 units multiplied by the selling price, 6 naira 80 kobo. What is this value, please?
4,760,000.
4,760,000. The total sales is 5,750,000. External sales is 4,760,000. What is total internal sales value, please?
990,000.
You just do total sales minus external sales. The difference becomes 990,000. This is internal sales. This is the internal sales. Internal sales means sales from Aba division to Beta division. The total external sales value is 990. Now, how many units will Aba division sells to Beta division?
200.
200,000 units. Aba division will produce 900,000 units. It's going to sell 700,000 externally. That means 200,000 is sold internally. That 200,000 will give you, that 200,000 units will give you 990,000 naira. What is internal selling price per unit?
4 naira
Look at
95
it.
kobo.
Just come here. Look at it. Look at this. Internal sales price per unit is equal to total internal sales 990 divided by quantity sold internally, 200,000 units. That will give us 4,990. That is the transfer price that we achieve a target residual income. That is requirement A. The transfer price meets the target residual income. That should be 4.95 naira. We have to work from that target to our sales value, because we are trying to meet that target of 700,000 naira residual income. You have answered the A. The transfer price by Aba division to meet its budgeted residual income target should be 4.95 naira. That is A for you. Any question, please? Any question, please?
Sir, is there a way to check that the figure we got for our transfer price, is there a way to check that it will still give us that 700,000? Maybe a quick way.
Why not? 100%. That will automatically give you back now. That one is 100% now. Just take that transfer price, open an income statement. Open an income statement. Take the transfer price. You are going to do external sales plus internal sales, then minus your variable cost. You do external sales. Your external sales, 700,000 multiplied by 6.80 naira, you get your figure. Internal sales value, 200,000 multiplied by 4.95 naira, get your figure. Then get your variable cost. Then when you get your variable cost, total variable cost, get your contribution, less your fixed cost, get your profit. Once you get your profit, go and compute your residual income. It will return back to you 700,000. Automatically. Look at the B. That is the only calculation we are going to take. Look at the B part of the question. Calculate the selling price per unit, which beta division should quote to external markets, in order that its budgeted residual income targets will be achieved based on the transfer price quotation. This requirement B is also similar to A. That residual income targets, that's what we are working towards. If you have to solve this, you can see my whiteboard being shared.
Yes, sir.
You are going to take the same approach again. Take the same approach. You come to your B. B. Now I'm dealing with beta division. Beta division we buy from components from Aba division. I'll now come here. Look at it. I will start with the residual income of beta division. How much, please?
500,000.
Now, capital employed multiplied by the cost of capital for
Beta.
Division.
300,000.
Multiplied by the cost. Let's show it. If you look at it here, capital employed, 3 million multiplied by 10%. That will give us 300,000. Please add this back to residual income. 300,000. That will give me 800,000. That 800,000 is the profit of beta division. Once you get the profit, add back divisional fees cost. Divisional fees cost. What is the fees cost for beta?
140,000.
If you add these two together, what do you have? 940. This is the contribution of beta division. Now, the variable cost of beta division.
It's not given.
It's not given. Ow. Say it's not given. Ah, that would be, they must, it's already there. If beta division is buying components from Aba division, won't it incur cost?
Me too.
So beta division will buy 200,000 units of components from Aba at the transfer price. What is the transfer price? 4.95 kobo. 200,000 multiplied by 4.95 kobo. What do we have?
990.
990. Now come here. Where is this mouse ID? Just come here. Variable cost. We are going to have two. We have internal purchases. Once there's internal sales, there must be internal purchase. 990. Look at this. What is there? Internal purchases. Aba division will purchase 200,000 components from, beta division will purchase 200,000 components from Aba at the rate of 4.95 kobo. That is the internal transfer price. That will give us 990. In addition to this, beta will incur further processing costs. Can we see that?
Yes, sir.
Further processing costs. Now, we have beta, we have 200,000 components. It's going to further process at a cost of 4.50 naira kobo. Further processing costs. Look at it, further processing costs is equal to 200,000 units multiplied by 4.50 naira kobo. That should give us how much?
900,000.
900,000.
900,000. That is the variable cost. The two. Now add the three together. Contribution for the two plus the two variable costs.
2,830,000.
That is the sales value.
Yes.
That is the sales value of beta. 2,830,000. And if you look at beta, beta does not have internal sales. Beta sold everything externally. Beta does not sell to Harvard division. You only buy from Harvard division. Beta does not have internal sales. Every sales is external to beta. So beta will sell 200,000 units. Beta will sell 200,000 units. Total sales value is 2,830,000. What is selling price per unit for beta products?
14 naira 15 kobo.
Just come here. Just come here. Need to round up this class. External selling price. That is the external selling price. No internal selling. External selling price. Per unit is equal to 2,830,000 divided by 200,000 units. Oh, maybe the same. Naira amount. This will give me 14 naira 15 kobo. That is the external selling price of beta. You are done with B. Sorry, I'll just take your 10 minutes. I'm done. I'm not solving anything again. If you go to the question, the remaining questions are just theories. You don't want to move to the question. If you look at C, explain why the transfer price calculated in A may lead to suboptimal decision making from the viewpoint of Garki PSC. Explanation is here. The transfer price to beta division will be suboptimal to the company as a whole, since 6 naira 80 kobo is the price to external customer, while 4 naira 95 kobo is the price to division, necessitating a loss of 1 naira 85 kobo. You can read on. You can read this on. What you are supposed to sell for 6 naira 80 kobo, you are selling for 4 naira 95 kobo internally. It's a loss to the company.
Hello, sir.
Yeah.
Since the question says that the Alpha division can only sell 700,000 units out of the 900,000 that they are producing, shouldn't the remaining 200 that will be transferred internally be a profit?
Be a profit out.
Because they can't sell it outside.
How does it become a profit now? I'm trying to reason it. You can't sell outside, I agree. You now transfer. You are now transferring as 495 cover. How does it become a profit now? To the company.
Because I'm
How
thinking
does it
if they can't sell it outside, it would be wasted.
and I agree. If you are now selling to Peter Division, I agree with you. How does it translate to profit to the company? If Alpha Division manufacture a component and sell to Beta Division, how does the company make money from it? Please remember, internal transfer does not contribute to the profit of the company. The only time the company is making profit is where you are making external sales. It's like saying you have two shops. You have a shop in Lagos, another shop in Ibadan. You are now your shop in Lagos is selling goods to your shop in Ibadan. That means your shop in Lagos we have sales revenue. The shop at Ibadan we have cost. Revenue we cancel out cost, or cost we cancel out revenue. Now that transaction will not translate to any profit to the company as a whole. I hope that point is clear.
Yes, sir.
You can read more of this. Please read this. The last aspect, that one is also notes. In what circumstance would negotiated transfer price be used instead of market base? Just read. Negotiated transfer price is better used where there is a spare capacity. We can discuss the price. You can now you can read more here, but I'll give you the basis. Negotiated transfer price is most appropriate where there is a spare capacity. But I have to stop here. Any question, please? All right, I will be stepping out of the class. May God give us a better understanding.
Amen.
Good night and remain blessed.
Thank you.